At BMO Insurance, customer experience is a promise. A promise we back with clear, measurable service level agreements. In the last year, our teams supporting you have driven real results. Now, progress sets the pace. Smart app submissions reach underwriting within 1 day of submission, and 99% processed within our service level agreements. Policy settlement within 2 days, and claims completed within 10 days. We know time is valuable. That's why our new business team routinely answers phone calls within 1 minute and provides email responses within 24 hours. Because when SLAs deliver, your business accelerates. We've redefined what fast and reliable service looks like, empowering advisors with the tools to drive business forward. Service level agreements aren't just targets, they're a commitment to our advisors. And at BMO Insurance, we're raising the standard.
The next evolution of Rover AI is here. It delivers real-time insights, products, and underwriting information and quick access to advisor resources, all in one smart tool designed for real-life conversations. Let's talk about how our advisors are actually using Rover AI every day to make their business better. When client situations get complex and advisors need answers, they need them fast. With Rover AI, advisors can ask real questions about real scenarios. For example, how multiple medical conditions may impact underwriting, eligibility, and product options. Rover AI then analyzes the details, surfaces relevant consideration, potential outcomes, and practical next steps, all in one clear response, grounded in real-life use cases. This helps advisors prepare for better conversations, set the expectations earlier, and move forward with confidence. Advisors often need to go deeper as conversations evolve. With Rover AI, follow-up questions are seamless. They're connected. An advisor asking about a 55-year-old male with type 2 diabetes diagnosed a few years ago and whether the client may be rated. Rover AI then assesses the medical information and provides a clear underwriting perspective with follow-up questions. The client is planning a 3-week trip to Vietnam. Does that change anything? Rover AI then factors in the travel details, confirm that the client would be assessed as standard for the planned travel. By building on each question, Rover AI helps advisors stay informed, reduce uncertainty, and guide conversations with confidence. Sometimes advisors need more than an instant answer. They need the right resources and they need them fast. When an underwriting question cannot be answered right away, Rover AI steps in with support. The advisor submits the questions and Rover AI confirms that a detailed assessment will be delivered by email within 24 hours. No guesswork, no dead ends. Rover AI also makes it easy to assess the right documents and contacts in one place. From business development team to new business and client services, compensation, digital support, and key team information is always just within reach. Advisors can quickly reference procedures like conversations, withdrawals without searching across multiple systems. That's the beauty of Rover AI. It always provides direct access to all the forms needed for each transaction. Rover AI helps advisors save time, stay supported, and keep their business moving forward. Our industry doesn't need more tools, it needs better ones, and that's Rover AI. Rover AI is a tool built with advisors, built for advisors. So log into your portal today and explore Rover AI. And if you need more assistance, connect with your business development manager. We're here to help.
Hi everyone, I'm Raja Khouri, VP Business Development, Wealth Products. Canada's economy has shown more resilience than many expected, but the forces driving growth are clearly shifting, from cooling interest rates expectations and a cooling labor market to ongoing global uncertainty. these dynamics are having real everyday impact on how Canadians think about money and financial decisions. To help us make sense of what's happening, and more importantly, what actually matters for advisors and their clients, I am joined by Michael Gregory. Michael is the Deputy Chief Economist and Managing Director at BMO Capital Markets and one of Canada's most respected voices on economic trend, market dynamics, and central bank policy. In today's LifeFWD conversation, we will explore the key economic signals shaping the current environment, what the data is telling us about growth, inflation, employment, and rates, and how advisors can translate that insight into confident, real-world guidance for clients navigating volatility and uncertainty. Michael, great to see you. Thanks very much for joining us on this LifeFWD.
My pleasure.
I want to start off by setting the stage and talk a little bit about the Canadian economy. Some say Canada's economy has been more resilient. From your perspective, what does that mean for the average investor?
Yeah, resilient is one of those kind of words that is in the eye of the beholder. I think the way to think about it is that when tariffs were first introduced back on February 1st of 2025, folks thought maybe we were headed to a recession. And on top of that, we had policies that were shrinking the population in terms of the growth because of immigration. And this was like a double whammy on the Canadian economy. People were talking about recession. And lo and behold, growth has been muddling along. It's not been great, but it hasn't been as dire as many folks thought it would be a year ago. And because of that, there's a sense of resiliency. And some of the things we've been doing to offset those two big headwinds are actually is what's giving us that resiliency. And importantly, sets the stage for even better growth once things calm down, say on the U.S. trade policy front.
Can you talk a little bit about those two things that you mentioned?
Well, I mean, obviously, Canada has a very large economic exposure to the U.S. And when it looked like we were going to get widespread tariffs on everything we sell to the Americans, that would have been devastating for the Canadian economy. As it turns out, the tariffs are announced, they have like a big roar, and then by the time they get applied, they're not as onerous as they otherwise would be. For some sectors like steel and aluminum, and for select parts of the auto sector, copper, other kinds of select industries, it is pretty severe. But these are relatively small parts of the overall economy, and most of what we trade with the Americans is still tariff-free. Right. So that meant that headwind, it was there, but not as sharp. And on top of that, we just had these policies to slow the growth of immigration because things had gotten a little bit too rapid. Let's put it this way. Population growth in Canada at one point was growing 3% year on year. That gives you 3% growth almost just by turning on the lights to start the year. Now we're close to zero or slightly above zero. So that's a lot of headwind or tailwind rather that's been taken out of the economy. And we're feeling the impact of that, but consumers have still stepped up, which has been perhaps the biggest surprise, I think, so far over the last, say, year.
Any headwinds or any major headline from your perspective that did not get enough attention?
Well, I mean, all the big data, all of those, of course, make the headlines. But I think a lot of economists, when we were trying to find ways to deal with what were the risks to the Canadian economy, and this whole Buy Canadian movement began. Folks decided, I'm not going to vacation in the United States. I'm going to vacation in Canada. I'm going to go into the store and I want to know what products are made in Canada so I could shift my purchases towards those, even if they cost a little bit more. And I think the big surprise was how successful that was. And I think it's saved a lot of businesses across the country and actually provided, interestingly enough, a little bit of extra lift, a little bit of extra spark for the economy.
Well, okay, so how would you say, or how would you categorize the economic shift based on what you just explained in terms of consumer behavior changing with the sentiment wanting to be buying maybe more Canadian product and investing more in Canada? Would you say there's a sort of a change in?
Well, definitely there's a change in terms of purchasing decisions, not only of goods, made in Canada. If you can stamp that on your label, chances are you can do a little bit better now than you did 2 years ago, but also on the services side. Vacationing in Mexico instead of Florida or wherever the case may be, and I think that makes a big difference in terms of investing. Yes, maybe. Folks are still trying to think about investing a little bit more in Canada. But when you invest too, as you know, diversification is quite critical here. And Canada is a relatively small part of the global pie.
Right.
And so when you're investing, yes, maybe you give Canadian names a little extra look, but you still have to worry about diversification in terms of overall portfolio management.
If I can shift gears a little bit and just try to translate that from an advisor perspective as they're having conversation with their clients. And I think specifically about a signal, whether it be employment, inflation. Is there something that we should be focused more on in terms of signals within the economy?
Sure. Well, I think the most important thing is probably, believe it or not, inflation, because the Bank of Canada, at the end of the day, is an inflation targeting central bank. Everything they do on the interest rate side is through the lens of what are the risks to inflation, what's happening to inflation. So that is critically important. And right now we know inflation is starting to really begin to cool off. It seemed kind of stubborn at around that 2.5% range, but the shorter term metrics are all, down around 2 or less than that. So that tells me that in the event that we get more risk to the economy going forward, the Bank of Canada could feel a little bit more comfortable about potentially cutting rates further. Right now, they seem on hold indefinitely, but the risk is they may have to ease again. And with inflation coming off, that's the case. Now, on the employment side, we've got, various measures of employment. We get the labor force survey, which is one that gets announced a lot. There's one that's announced with a little bit of a lag. It's the payroll survey or the establishment survey. That one has been a lot weaker than the overall labor force survey, which is a survey of households. And so there's always been a little bit of concern as to whether or not the labor force survey is overestimating how strong the population growth is, and therefore how strong employment growth is, whereas the actual hiring that's going on in the economy, that has been pretty soft. And if I had to pick one area where the economy has probably been a lot weaker, it's been the fact that real job growth, has been pretty soft. And that's where businesses are being cautious. Okay. I'm not going to invest as much. I'm not going to hire as much until the economic picture clarifies a bit better.
You talked about inflation and potential future impact on interest rate, and inflation has come down. However, your average Canadian is paying more at the grocery store, more to fill up their gas tank. How do we reconcile that, or how do we explain the disconnect there?
Well, I think that ultimately inflation is the rate of change in the price level. And we went through this period when we reopened the economy after the pandemic, where there's a lot of demand, limited supply, and as a result, prices kind of surged around the world and in Canada and the United States specifically. And so the price level really got out of whack for a lot of Canadians. Now, if you say to them, "Oh, don't worry, inflation the price level is only going up 2% per year now." Well, if the price level, the cost of goods was already too high, the fact it's only going up 2% now is a little measure for comfort. What matters is, what are wages and incomes increasing? If they're increasing 3 or 4% per year, then if prices are only going up 2%, at least we're making a little bit of headway at chipping away at this affordability, which had deteriorated quite significantly. And this is something I think the politicians really haven't really understood. They pat themselves on the back saying inflation is down. But what really matters to Canadians is affordability, the cost of living. We all go into the grocery store and we go, "Oh my gosh, this is like 20, 30% more than I used to pay for it a few years ago."
Okay, so if we think about the economy and if it is expected to slow down further, what would be the first clue or signal that things are slowing down?
I think it'll have to go to the job side. Okay. It's businesses. Now, obviously businesses spending on capital equipment and other investment, that one is not as timely where their spending hits the road is literally, and are they actually hiring people? And if we're going to get a weaker economy, we will start to see some softness there, which will eventually translate into a higher unemployment rate. That's not where we're at right now. That resiliency that you mentioned initially has afforded sort of a level kind of playing field here. We're kind of moving sideways, kind of ready to pounce. And I think that's the proper way. Investors have cash. Right. Businesses have cash. They're waiting to deploy. All you've got to do is clarify the economic scenario just a little bit better.
From a central bank perspective, where are they at right now?
Rates are now at the bottom of what they consider to be the neutral range.
Right.
They've said, listen, we're going to ease as much as we possibly can, because we're kind of concerned about fueling inflation too. So we do realize we have to provide as much support to the economy by lower interest rates. And that helps the housing market. It helps credit-based spending, automobile sales, big ticket purchases, things like that. And that's what they've done. And they're going to hold here for a while, depending on what happens in the economy. In the meantime, we're now relying on other sources of growth other than in just lower interest rates. The federal government is stepping up with a whole bunch of measures to try to, to boost the economy. And that's probably the ones that have the greatest legacy for how this economy is going to look 5 or 10 years down the road.
Okay, if I can just translate that from a client's perspective, advisors are having conversation with their clients, and often they're having to explain all the volatility that we're seeing in the marketplace. From your perspective, Michael, how do we explain all the volatility, or is it just really bad headlines?
Well, I mean, the volatility is real, and the one that kind of gets the clients notice the most is the volatility in markets. Sure. That's when you get the telephone call. Hey, the market's up, the market's down. And of course, part of our job as advisors is to advise that, there's a forest behind these trees, and they're more fundamental things we should be thinking about. When you get volatility, you get times when not to sell, you get times when to buy. Right. When assets get marked down in value. And I think the headlines seem to matter a lot more now, for the simple reason policy is now announced in social media posts. And so is it real? Is it not real? We worry about, news stories. Are they real? Are they not real? That image, that report, is it real? Is it not real? So not only do we have this volatility in markets, we get a barrage of information, some of which is not real. And that is the scary part, which is why I think ultimately, it's nice to have a place you can go to, get some second sober thought, put some things in perspective, and hopefully make decisions from a more rational framework.
You talked about uncertainty. Would you view that more as cyclical or something more persistent at this time?
That's a good question. Right now there's lots of uncertainty because, we're transitioning our economy from a model where we're kind of dependent on selling to the U.S. to doing a bunch of different other things, including selling to other people and selling amongst ourselves a lot more, which is something we really haven't taken full advantage of. And so I do think that uncertainty is going to persist because we're going into new markets. And it's easy to sell in America. It's a lot harder to sell in Britain. We speak the same language, sort of. But the bottom line is that, it's higher costs. And in fact, that is something the Bank of Canada is very sort of aware of, that this transition we're going through, this structural change, could last for a while. In the meantime, that tells me they're going to try and keep interest rates as low as they possibly can for as long as they can, as long as inflation stays well behaved. And the latest information says, we're kind of well behaved. So, bet on those interest rates, not going up for some time.
From a client perspective, again, what fundamentals should advisors be pointing to keep their clients grounded?
Well, we have all our models of, valuations and things like that, right? And I think that those are very important. And there's various little valuation hooks we can hang our hats on. And it's important to understand, well, we're overvalued from this perspective relative to interest rates. We're not overvalued, or whatever the case may be. But it's important to step back even further and just look at the economy. And is the economy performing well? Well, we are resilient. You mentioned about the resiliency. We're actually doing better than we thought we would. And that tells me that a year or 2 or 3 years down the road, we could start getting growth back again that we were kind of used to. And if the financial markets are taking that into account, which they often do, then yes, it makes sense that right now things look like they're a little bit more expensive from an asset price perspective. At the end of the day, I think just keep an eye on the economic pulse. Right. And there's lots of economic information out there. And at the end of the day, whoever you listen to, the role of the advisors is to try to channel some of that information to clients so they themselves can go, you know what? And this was advice given to me when I first started the business. The economy is never as strong as the strongest piece of data, and it's never as weak as the weakest piece of data. And often people trying to convince you one way or the other will focus on just the weak data or focus on just the strong data. It's important to take everything into context to really give a good perception of where the economy is. And we are muddling along. We're doing okay.
So you clearly explained that the economy is doing better than expected. However, we're still feeling some financial pressure. How do we explain a bit of the disconnect that we see when you compare where we're at, particularly from a year ago, versus really what's happening out there?
Well, I think you're right. I mean, when you look at the numbers and you ask people how they feel, and they often feel a lot worse than the numbers would suggest they should be feeling. And I think it comes down to that uncertainty you were talking about. We are muddling along. We know things could get better, but they also could get worse. So is this uncertainty. Are tariffs going to go up? Are they going to go down? Will trading more interprovincially, will that help? Will trading more with Europe or Asia, would that help? Will increase defense spending? Would that really provide the spark that we need for the economy? These are all questions. And at the end of the day, they filtered into jobs and opportunities. And so I think there's this uncertainty. Something's new. It's like when you start a new job or in a new relationship. Right. It's exciting, but it's a little bit nerve-wracking at the same time because we're literally trekking new territory for Canada. Territory we should have already trekked by now, but we relied so much on the U.S. for so long. No more. Now we're going to sort of, put our destiny basically in our own hands.
Speaking of sort of our new destiny, where do you view, or who do you view as some of our strongest partners or allies if we need to sort of detach ourselves a little bit from our historical relationship with the U.S.?
Well, I do think, and you just have to look at how many trips the Prime Minister has made to foreign countries. Europe is obviously an area which is critically important for Canada. We share very similar values with respect to social issues, with respect to the environment. So it's very easy for us to align with the Europeans. In fact, we're looking at buying military equipment from the Europeans because we're integrated with them in NATO and things like that. So I think that's the natural sort of move. Yes, Asia is important too. Asia is a lot further away. Europe's a lot closer. It's only a few hours to fly to the UK.
If I can pair it back from a Canadian perspective, particularly from an advisor having conversation with their clients, if I can focus on household debts, from your perspective, today's household debt, average household debt in Canada versus a year ago, how would you categorize where we're at?
It's come down, mainly because the interest rates have come down and activity in the housing sector has cooled quite considerably. And meanwhile, folks have been paying off their debt as part of they normally do. Debt levels are high. There's no question about it. Debt levels are also high because Canada has very high rates of home ownership, and most people don't pay cash for their houses; they take out mortgages, and that's a very big part of household debt. And it also means that the Canadian economy is probably a little more sensitive to interest rates than other economies, say in the United States. And as a consequence, with the Bank of Canada trying to keep interest rates as low as they can for as long as they can, that actually at the end of the day may provide a little extra lift for the economy.
From a U.S. central bank standpoint, do we expect interest rates to come down?
We actually think that they'll cut interest rates again. Not right away. The data is kind of mixed right now, but rates are still slightly above neutral. Whereas they're clearly at the bottom of the neutral range in Canada, they are still slightly above neutral in the US. And ultimately, I think central banks want to get down, as long as inflation is behaved, to neutral. And slowly but surely, inflation, while it does seem to be a little bit sticky in the US, is coming down. That's great news. And so we do expect that they'll cut rates at least 2, maybe 3 more times, quarter point moves, so another 75 basis points. What that does mean, as the Fed cuts rates and the Bank of Canada, we believe, is going to be on hold for the foreseeable future. Okay. That just means that the Canadian dollar may get a little lift from the fact that rates are falling in the U.S. but remaining sturdy in Canada. Something to keep in mind that a firmer Canadian dollar may be in the cards.
From an advisor perspective, is there a key message for at least this quarter that they should be reinforcing with their clients?
I think a key message would be that there's lots of uncertainty, but our policymakers are on top of it, right? The Bank of Canada is really on top of what's happening in the economy. They are doing all they can right now. Now the government is stepping up. We had that new defense policy that was announced. We have all of these fast-track infrastructure and natural resource projects of national significance getting approved or getting ramped up more quickly. And we're working hard on trying to trade with other countries and of course, trade amongst ourselves. And so all of these things are now happening. Now we're gaining a little bit of traction. The uncertainty is still there because this is all new. But I'm kind of hopeful that if you add the resiliency we've had so far, even though the economy is muddling along, plus all these things we're trying to do to increase growth, the future is looking a little brighter.
Are you bullish on the Canadian market overall, or is there another market that you feel strongly about?
Well, I am bullish on Canada. I think that Canadian assets had reflected the fact that Canada was more exposed to U.S. trade policy than other countries. The old adage, when the U.S. sneezes, Canada catches a cold. That may not be the future anymore for Canada. And as more and more investors began to recognize that's not the future for Canada anymore, yet Canada has an abundant supply of critical minerals and other natural resources and energy, Canada, still future may brighten in the eyes of a lot of international investors, let alone domestic investors.
What should average investor be looking for in terms of headlines versus some key signals? We talked a lot about that in our opening interview. Is there something that they should be focused on moving forward to build their own confidence as they're having those conversations with their advisors?
I think you have to look at things like job growth. Our business is beginning to hire again. Our business is beginning to spend again. Do you notice in your neighborhood that there's a crane that's gone up in your local town? The activity is picking up. I remember, former Prime Minister Jean Chrétien used to drive through cities and count the cranes. Right. That used to be a sign of economic activity. In fact, many folks used to do that in measuring how much growth there was in China. He used to count the number of cranes that were there. So when you start to see things happening, it means businesses have got that level of confidence now where they're prepared to start spending a little bit more money. It means capital spending, it means hiring, which means the worst potentially is over.
Michael, if you had to sum up the economy in one sentence, what would that be?
I think it would be uncertainty, yes, but prospects are brightening.
Michael, thanks very much for your time. Very good seeing you. Always enjoy my conversation with you. Extremely insightful. And I'm sure all our advisors out there appreciate the information. Thank you.
Thank you. It was fun. I appreciate it. Thank you.
Thank you again for joining us. On our next webinar, we will be joined by Katerina Nikolic, Vice President and Chief Corporate Underwriter at BMO Insurance, and Dr. David Alter, cardiologist at Milton Cardiac Care Clinic, hosted by Gregory Young, Vice President, Business Development, Life Products. Together, They will discuss why heart health remains the #1 cause of death in North America and what can be done to improve heart health.